Hello everyone and welcome. If you have been following my recent vlogs, you will know I've been highlighting how Wells Gibson builds portfolios for our clients. Last week we looked more closely at higher risk growth assets, which we regard as the engine room of your investment portfolio. In other words, the element of your portfolio which is likely to fund your financial future. I can't stress this enough though. You need to remember most of your portfolio's return will come from the market and not from market timing or attempting to pick winning fund managers or shares for that matter. Diversification is vital if you want to capture market returns effectively and efficiently, and this is why the growth assets component of Wells Gibson's portfolios are highly diversified across asset classes, across countries, industry sectors and companies. This week we're going to briefly look at how you can balance your portfolio with lower risk defensive assets, which we believe play an important role in all portfolios. For more cautious investors, lower risk defensive assets provide downside protection because they deliver lower levels of potential falls than the falls we would associate with higher risk growth assets such as equities. Also, as we expect the long-term return to be above inflation, this should preserve the purchasing power of your investment portfolio over time, albeit this is not guaranteed. If you are a more risk-tolerant investor, lower risk defensive assets can give your portfolio the balance it needs when there is a market crash, such as the financial crisis that we saw between 2000 and 2009, or as we saw earlier this year as a result of the coronavirus. At Wells Gibson, we regard lower risk defensive assets to be short-term, high credit quality bonds. Short-term bonds are less volatile than long-term bonds, and high credit quality bonds are less volatile than low credit quality bonds. Also, high credit quality bonds do tend to attract more money when there is a market crash or a large fall in equity markets, and this in turn increases the value of these bonds. So in summary, lower risk defensive assets are likely to be appropriate for many investors. However, finding the balance between defensive assets and growth assets that is most suitable for you will be one of the most important decisions to be made. That's all for this week. However, next week we will consider how you can identify the portfolio that is right for you. Thank you for watching, and as always, please visit our website at wellsgibson.uk. Thank you.